Good afternoon, everyone. This is Trisha from Underwriters Marketing Service. Thank you so much for joining us. Just a couple quick disclosures. First of all, this session is being recorded and it is intended for financial service professionals only. So with all that out of the way, again, thank you so much for joining us today. You timed this perfectly for joining this session today, as literally there's some breaking news, some updates that Josh just got this morning about some of the opt-out and everything with this. One of the reasons we brought this to you, what's next after Washington State? Of course, this is LTC Awareness Month, so we always put on an educational series this month about long-term care planning topics. And even though this is Washington State, we all know what happens in one state eventually migrates over and to impact so many of us. So that's what today is about. What did happen in Washington State, what is going on in Washington State, and then what is going on in the other states around us. So everyone is in listen only mode today, but please, please, please type questions into the right-hand panel, and Josh is an expert on this topic. He will answer as many of them as he can for you. With us today, we have Josh Ford from Nationwide. He is our nationwide wholesaler. Those of you that were at our sales symposium hopefully spent some time with him. And he has spent his entire career here in the linked benefit arena. So without further ado, I'm going to turn it over to you, Josh.
Awesome. Trisha, can you hear me loud and clear?
Yes, you're good.
Perfect. Always have to do the infamous mic check there. But I appreciate that introduction, and I thank everyone for their time this afternoon. This is a very timely topic, for anyone who is doing any sort of life or long-term care business with any carrier. You've certainly seen some of the impacts of this Washington state long-term care bill. So what we want to do today is really introduce that and remind you of what happened or what is happening in Washington state. And then we want to look ahead. What's happening in other states at the federal government level that will mimic what happened in Washington state? And then really at the end of the day, why does this matter to you and where the sales opportunity is? So as we go through today's conversation, we'll certainly be talking about some tax related subjects. We'll be talking about some client engagement opportunities. Everything, of course, should be taken as educational. Nothing should be taken as a recommendation. We have our ever popular disclosures here. I always say this all the time, we can lead a horse to water, but we can't tell them when to drink. And that is definitely prevalent in this conversation. I'll try to keep today's content to about 25 minutes or so, but as Trisha said, we'll have the ability to answer any questions that you bring forth and certainly utilize the chat feature that Trisha is going to be monitoring to ask any questions or make any additional commentary if you have something that may benefit the group on this topic. So without further ado, we'll get right on to it. We're really going to touch on 5 separate areas. We're going to talk about in the beginning, giving a background of that Washington Cares Fund, just for anyone who may not be familiar, or a reminder for someone who was working with it previously. We'll talk about some of the things that we learned from Washington and that we hope other states learn from it. We'll look at the other states that are considering something similar, along with some federal legislation. And then we'll talk about why private long-term care, and then some tools that Nationwide has to help you have meaningful long-term care conversations. So in the beginning, in the very beginning of this conversation, we put in reference the Class Act, something that a lot of people may be familiar with. It was part of that Affordable Care Act, but it was repealed back in 2013. The biggest concern with the Class Act was its ability to be financially sustainable long term. They didn't see that bill being able to last at least the next 75 years, so for the people to use it. So that was repealed almost 8 years ago now, or a little over 8 years ago. But that idea paved the way for the Washington Cares Fund. And that is the new legislation that is actually passed and will be taking place in Washington State starting January 1st of this upcoming year. So essentially, the Washington Cares Fund, it was actually rejected by the voters twice, but the legislators still put it into the bill. Will pass the bill to make it happen. And essentially, what it is a payroll tax that is going to fund a state-run long-term care plan. Currently, the payroll tax is 58 cents for every $100 of income, and it applies for all W-2 employees. Self-employed individuals or individuals who are currently unemployed for any reason will not be in that tax right now. If anyone does become a W-2 employee in the future, as the bill stands, they will then be opted into the taxes. But not having these self-employed individuals included certainly is something that has a major impact, and we'll discuss that going forward. To make sure that this bill was financially sustainable, Washington State really has three levers that they can pull or that they're trying to pull. Um, the first is that the tax can go up. Again, that tax is 58 cents for every $100 today. But as the bill currently stands, that can be increased to up to 63 cents for every $100, which will have a major impact long term. And then the second lever they can pull is that they can adjust the benefits. So the current benefit on that Washington Cares Fund is $36,500 as a lifetime limit, which is roughly $3,000 a month for a year or $100 a day. That benefit is set to increase over time with some sort of inflation. But if there's any sort of downfall as far as the fund may not be financially sustainable, the state does have the ability to either level out and not add any inflation or decrease that cumulative benefit. So it's very possible that in future dollars, anyone who is benefiting from the Washington Cares Fund would not have that $100 a day equivalent. One thing to note about that $100 a day benefit is that that is a level benefit, and that is regardless of how much you pay into the program. So a lower income individual may end up paying in less into the program than they receive in benefits, whereas a higher net worth individual may end up paying 3 or 4 or 5, many times more into the program than they would ever receive. So again, that benefit is level, doesn't adjust based on how much tax revenue an individual has paid. The third lever that the state is trying to pull, which has been contentious and been shot down, but it's still being worked on, is they would like to invest the tax revenue into the market. And the reason they would like to do that is that already the fund hasn't even been placed in force, hasn't even started yet, and it's underfunded. The Washington Cares Fund Committee received all of their actuarial data prior to COVID. So now with everything being shaken up just a little bit, their numbers are slightly off. And the first lever that they will try to pull is have the taxes go up. And if it gets passed, they would like to invest those funds in the market. And that just shows how far behind they are if they're willing to take that sort of a risk over time with the money. One of the things that everyone, like I mentioned, is noticing if you're doing any sort of life or long-term care business are some delays from an underwriting and new business standpoint. And those delays are due to the fact that Washington State actually had an opt-out window for all W-2 employees. So for anyone who had a long-term care policy prior to November 1st, so prior to this Monday, they could go to the state and they can request an opt-out by proving that they have long-term care insurance. And just this morning, we got some figures that are pretty interesting on this topic. Initially, the state of Washington expected for 100,000 people over the course of their opt-out window, which ends December of next year, to opt out of the program. Now, with COVID really bringing life insurance to light and showing the importance of that, that number of opt-outs already is tremendously higher than what Washington State expected. Again, they only expected 100,000 people to opt out over the course of a year. Within the first 30 days, the opt-out window started on 10/1. The first 30 days, over 280,000 exemption applications have been submitted. 280,000 in a month. That, of course, impacts the funding for something like this. And those levers I just talked about, reducing benefits, increasing taxes, trying to get approval to invest the funds in the market, those become even more important because already they are almost 3 times, they'll have at least 3 times less people paying into the tax than they assumed. And we still have another year for folks to submit their long-term care policies and opt out. So it's certainly possible to see a tremendous landslide of individuals opt out of this tax, leaving the Washington Cares Fund underfunded, and the requirements for them to keep it sustainable are certainly going to go up. So this is all important because as we move forward, we're hoping that other states who are considering something very similar learn from all these missteps and these miscalculations that Washington had. Now, the first misstep was certainly underestimating the number of people who would opt out of the program. The second step was not including non-W-2 employees. All those individuals who are self-employed, generally they are higher income than a lot of W-2 employees. And Washington State just completely missed out on that tax opportunity. And while self-employed individuals could opt in, we highly doubt we see many, if anyone, opt into a program such as this. So that's going to lead again to increasing the taxes and the need to have this be sustainable long term. And it's really going to impact those who couldn't opt out, those who may be in low income families who can't afford a traditional long term care plan. Their taxes is going to be increased because Washington, made a few missteps. That opt-out window that we also discussed was something that we don't foresee other states doing because Washington is losing so much tax revenue, allowing higher income individuals to opt out. We actually had a handful of cases where we had very high income earners, people who may not be open to the long-term care conversation usually, but because we're talking about taxes, we're talking about a threat to their income. Those individuals who may be $1 million, $2 million earners were just turning that tax revenue, which was about $12,000 to $15,000 a year, into a long-term care premium. They're getting all the caveats of having their own private LTC plan, but Washington State is missing out on that $12,000, $15,000 taxes for the next 30 years, again, leaving them underfunded. One of the big things about the Washington Cares Fund, and I'll spend a couple minutes on this, is that third bullet point. The cognitive impairment is not a separate qualifier because this is huge. With traditional tax qualified long-term care, the 7702B qualified plans, in order to trigger a claim, an individual has to be certified to be unable to do 2 of the 6 activities of daily living or have a cognitive impairment. Either or triggers a claim. In Washington State, they have their own ADLs, their own activities of daily living. They have 10 of them total. And in order to trigger a claim, an individual has to be unable to do 3 of the 10. Cognitive impairments is actually 1 of the 10. So if someone is diagnosed with early Alzheimer's, they may be still good to go. They can get around for the most part. They can usually take care of themselves, but they may need supervision. That doesn't qualify for a claim under the CARES Fund. And that's important because about half of all the claims that we see for individuals 65 or more are cognitive based in some way, shape, or form. And many of them are supervisory. These are individuals who are normally pretty independent on the day-to-day, but they need a home health care agent or someone to be in the house because sometimes they'll leave the doors open, or they'll leave pots on the stove. They'll generally put themselves in situations because their mind slips that can cause harm. But again, under Washington Cares Fund, you cannot trigger a claim for that. So there may be a lot of individuals in Washington who will not be able to trigger claims when they need it. They will have to wait until they are really at the final stages of their cognitive impairment claim or event in order to file a claim with the state. So that's a big misstep, a big piece that does not serve the demographic of Washington too well. The two other things that we learned from Washington is how this impacts out-of-state employees, which is another big piece, because this certainly impacted residents of Washington state, people who live there, work there, do their tax there. They are Washington residents through and through. But what about people who don't live in Washington, but are employees there? People who are coming from Oregon or Idaho, Northern California, Arizona, commuting back and forth for work. Those individuals, because they work in Washington, are typically enrolled in that payroll tax, and they're going to pay into that benefit without ever receiving dollars from there because the Washington Cares Fund is not portable. Only claims filed in Washington state will receive benefits from the Washington Cares Fund. So there's an entire subsection of the population who is going to pay into this tax indefinitely as the bill currently stands and will never see a benefit dollar from it. But we also have to think about how this impacts in this new world that we have with virtual and part-time employees. Anyone who is considered a Washington state employee, and they can check their pay stub and see if they pay into the PFML, which is the paid family medical leave, those individuals are also going to pay the Washington state tax. That's even if they live in Texas and they're a virtual employee who got the ability to move back to Texas. Now that their job is now work from home, or they live in New Jersey or Florida. If they are technically Washington employees by definition of their role and they pay that PFML, they are going to be opted into their taxes. And that's important as we look at other states. This can have a much larger impact. So I want you to remember that out of state individual still paying the tax component, because we'll bring that back in just a few minutes here. The last thing that we learned from Washington is their vesting requirement did a disservice to the pre-retirees. So in order to receive a benefit from the Washington Cares Fund, you have to pay into the program for at least 10 years with no longer than a 3-year gap. So essentially, if you are in your pre-retiree stage and you plan to get out of the workforce prior to 2032, you will pay into this Washington Cares Fund until your retirement and then never be eligible for a dollar because you have not paid in for 10 years. And that's tremendous because that pre-retiree market are a lot of our higher income clients. Those are the CFOs, CEOs, high earning self-employed individuals who may pay into this, but then never get a single dollar. So all 5 of these are some of the major takeaways and some of the things that we learned from Washington State. And we hope that the other states take this into consideration as they formulate their own CARES Fund plans. And I'll touch on a few more things as we go through, how this affected the insurance companies. That buyout or opt-out option, as I mentioned, has caused a tremendous backlog across the industry. Here at Nationwide, we had about 14,000 Washington state applications submitted this year. 14,000. On a regular year, we only get a few hundred from Washington state. Now, the latest numbers that we looked at, there was about a 9,000% increase. 9,000% increase in Washington state submissions at Nationwide this year. And that's important to look at because as we do look at other states, again, we don't expect them to have these long opt-out windows. so that they don't suffer the adverse side of the taxes because they are cutting their own revenue quite a bit. But if we're looking at larger states, you know, what sort of volumes can the industry handle? If California or Texas or another huge state looks at something like this, the industry may simply be shut down just from a volume standpoint, as we saw in Washington. Carriers had to shut down. We stopped taking applications on the 10th of August just to try to manage the volumes. Carriers started raising face amounts. If we see another state do something similar, not getting ahead of it and having a conversation beforehand and beating the rush could result in your client being unable to secure a policy. So something to certainly think about as we proceed forward. One of the biggest impacts that this CARES fund has had on clients is that it has given them a false sense of security. And I almost call this the second Medicaid hurdle. How often do we hear from our clients that they think Medicaid has them covered for long-term care? It's the government program. Of course, it's going to be available if I need care. But they don't realize all the other things that go into it that really makes Medicaid an unattractive option for them. Or they just won't qualify for it straight out because of income or assets. The Washington CARES Fund has had a very similar effect on clients. They believe that the CARES Fund has them covered. No, I'm getting a benefit from the government. Why would I need to look at a private long-term care plan? No, they don't realize, one, they won't potentially get any benefits, especially if they are pre-retiree. And two, the benefit that they're getting from the government is uncertain. And in no case will it be enough to actually cover any sort of long-term care needs that they have. But the fact that the CARES Fund exists has created an additional hurdle for us to get over, and it certainly requires more education for the clients to understand really what long-term care is and why they need to have a private LTC plan. I don't want to necessarily say all the benefits of the state plan are bad. There really are three subsections of individuals who are going to benefit, and I feel like I should always highlight that to show who's going to see some good from this. First are low income employees who may be a little too rich for Medicaid. You know, the CARES Fund will act as a starting point while they spend down their assets to become Medicaid qualified. So it will do some good for those very low income people. Uninsurable employees, you know, individuals who simply cannot get any sort of private long-term care because of health reasons, at least they'll have the CARES Fund as supplemental coverage to help them uh, if they do need care. And then third, any individual who's going to pay less into the program than they'll receive in benefits. You know, anyone who's really, you know, 55 or so, making less than 500,000, as the math works today, they'd end up paying less into the program than they'd get back in hypothetical benefit. So they could see, you know, pretty good benefit from having this care fund. But everyone outside of these demographics, including our young individuals, will be adversely impacted by such a bill. And we touched on this, you know, a lot of individuals are left out. But the big question comes now that we talked about Washington, gave a good background, we understand some of the missteps that they made, some of the levers they can pull to increase the taxes. You know, why does this matter for anyone who's not in Washington state? Why does this matter for us in Pennsylvania, New Jersey, Connecticut, New York, Delaware? You know, why does learning about this matter to us? Well, it matters because this is becoming a national thing. And I'll pause on this slide for just a couple minutes because these are the next states who are considering a long-term care program similar to the Washington CARES Fund. And we've ranked them in order of those who we expect to make a move next. You know, California being the most notable and the largest, but any state on here could move up or down the list. And we actually put a pretty good disclosure at the bottom of the slide saying that this is not a complete list. Ever since the inception of the CARES Fund, every few weeks or few months, we hear of a new state adding on or a new state hopping off the list. Now, it's been somewhat in flux, but those top 3 or 4 states are the ones who have remained consistent and actually have something tangible on paper, or they have some sort of committee formed that is looking to formulate a CARES Fund committee similar to Washington. The important piece about California is, as I mentioned, they are a huge, huge employer. How many giant tech companies are out there? How many big employers are domiciled in California? We'll have individuals who live in those border states who commute to California for work who will be adversely impacted. And then if they do share that same um, tax requirement as Washington, we could see virtual employees or employees who have moved out of state while they have the virtual option pay into some sort of California tax that they will never receive a benefit from. So having meaningful long-term care conversations with our clients today helps us get around all of this, because nothing can beat the value of private insurance. The guarantees, the flexibility, the ownership, the certain financial planning that comes with a private individual long-term care plan cannot be beat by anything that the government offers. And that's not something that is new. We can typically do better as individuals than we can with a government program. The government programs usually are meant to help the masses or those who cannot provide for themselves. A lot of our clients who may be middle to high net worth who have the option to plan for long-term care will certainly see benefit from having an individualized plan. One common question that I get on this slide is, what if all the states drop off? What if California, Oregon, Hawaii, all the way down to Utah? What if every single state thinks that Washington did the wrong thing? This doesn't matter. We don't care. We're not going to form committees. What happens if every state just does away with their current plans for a CARES fund? Well, we still have the federal government to be on the lookout for. Aside from all of those individualized state bills or state plans, are 5 federal initiatives that are being mulled over and looked at to have long-term care be taken care of. And I'll highlight 2 of them just to show you the range on the ideas. We have the WISH Act at the very top. That is similar enough to Washington. It's a payroll tax of at least 0.6%. Again, Washington started at 0.58. They're looking at 0.6 because it is more expensive. And that would still be a payroll tax, and it would be a 50-50 cost share between the employees and the employers. So they're really trying to incentivize employers to offer some sort of even optional plan to their employees. Just as a quick plug, if you are working with any sort of employers, small or large, Nationwide's Care Matters product actually does have the option to be offered as a cost share between employees and employers. Certainly reach out to Trisha if you have any additional questions, if you're dealing with a case like that, because we can definitely have a meaningful conversation in an employer environment. But back to the WISH Act here. The WISH Act, like I said, it is that payroll tax. One of the big things to look at is the WISH Act does have an elimination period that's means tested between 1 and 5 years. And we'll pause just to think about how long that is. 1 to 5 year elimination period. Now, if you're looking at a private long-term care plan, it's not uncommon to see 30 days or 60 days or 90 days, or even on an older plan, 180 days. But with a middle to high income individual, we're looking at 3 to 5 years or up to 1,800 calendar day elimination period. 1,800 days before you can access your policy. And that just shows you nothing beats private insurance. It's just another notch in the belt, another confirmation that private LTC is going to perform better for most of your clients. The other federal initiative I'll touch on as I begin to wrap up is the Long-Term Care Affordability Act at the very bottom. And that one's a little bit better for the industry. In short, what it does is it allows for up to $2,500 to be used out of qualified money, both tax and penalty free, for long-term care. And that one, as an industry, we do like it. Encourages the use of those funds without any sort of adverse impact for the long-term care conversations. So again, aside from the states, aside from Washington, the federal government is also looking at long-term care, pushing the point even more to have conversations with our clients on a one-to-one basis before the governments begin to step in. And Tricia does have a copy of this presentation, which goes into more detail on all 5 of those federal bills. If you'd like to get more familiar with them, some of your senators or legislators may be proposing these bills, so it may be something to look at a little bit more in depth. But as I begin to close, why discuss long-term care? Well, we touched on a lot of important points, but in summary, it's because 30% of the US states are looking at some sort of mandatory tax incentivized program or tax run program. The government is also looking at tax programs to fund long-term care. Now, any opt-out on a go-forward basis could easily require that your clients have policies before the states announce. If California says June 6th of 2023, if you don't have a long-term care policy now, you can't go purchase one. You're enrolled into this taxes. So if you don't have those conversations and get something in place prior, your clients could be out of luck and they could be stuck paying some taxes that they may never be able to get out of. And then there's no guarantee on the benefits. There's no guarantee on the premiums or the amount of tax that they'll take. And your client is then stuck kind of in a limbo period, relying on the government for something. And we always want to avoid any rushes. We want to avoid underwriting rushes. We want to avoid new business clogs. We want to avoid our clients being unable to purchase policy because of raised face amounts or raised minimum premium requirements. So having those conversations today are certainly beneficial. And of course, long-term care is more affordable today than it will be next year. As clients age up, as rates change, as environments begin to shift, the amount that your client can purchase today will not be the amount that they can purchase tomorrow. So getting long-term care or applying and having the conversation while your clients are healthy and can get a discount for being younger only benefits your clients at the end of the day. And I want to show you some tools. Well, I'll touch on one thing really quick here before I show you some tools that Nationwide has to help. All of this information around the tax avoidance with some of these state-funded plans should only be the cherry on top. We still want to encourage positive, holistic long-term care planning. If it doesn't result in the sale of an LTC product, that's fine. But what we want to do is make sure that our clients understand the consequence of not planning for care, and then they develop some sort of cohesive and coherent plan to deal with long-term care if it does come up. We hope it never comes up. I hope I don't crash my car, so I don't use my car insurance. I hope that my house never burns down, so I never have to use my homeowner's insurance. But if it does, at least I have a plan in place. And we want that same courtesy to be applied to our clients if they do live a long life and need to pay for some assistance as they do live their life. We don't want to, encourage the use of minimum policies or just enough to get out of estate taxes. We want you to have meaningful, powerful, sustainable long-term care conversations with your clients. And Nationwide has a handful of tools to help you do that. The number one tool that we've seen used throughout this entire Washington Cares Fund process is the cost of care calculator. Because using the cost of care calculator, you can pinpoint where your client lives, and you can look at the cost, as you can see at that graphic on the side of the screen. You can look at the cost of care in their area. A lot of our advisors have been using this conversation saying, hey, Washington State is giving you $3,000 a month. In your area, it costs $7,000 a month. We need to bridge that gap. So let's at least solve for $4,000 to $5,000 a month with some sort of guaranteed inflation factor to make sure that we're having a cohesive plan and we're actually getting you an adequate amount of coverage. And this applies to individuals who didn't submit a policy for the opt-out either. There's a huge area of opportunity for individuals who now understand long-term care. It's a bit too late to get a plan, but now they understand what the state is giving them. So you can have a supplemental insurance conversation if you have any Washington State clients, and they will be much more receptive to it now that they understand what LTC is and really what the costs are. And to help you have that conversation and get those apps in, Care Matters does have an electronic process. There is an electronic application coming out in about 2 to 3 weeks here. We will have a digital interview. So instead of using the phone vendors and having some delays there scheduling and getting underwriting done, we'll be introducing the option to do everything online with a digital part two. We're pretty excited about that. Uh, and then we also have e-delivery. So you can submit an online application. Once the digital part two comes out, you can do your health and medical online, and then you can have your policy delivered electronically via computer. So it's a complete end-to-end electronic process. And of course, Care Matters offers cash indemnity benefits. Once your client qualifies, we cut them a check, and the check can be used for whatever the client needs, definitely their care, but any ancillary cost or additional dollars they have can be covered, with that additional benefit. So as I close here, just one thing to think about. The population of Washington State is about 7 to 8 million, depending on which demographic you look at. And that shut down the industry. We were absolutely unable to adequately manage that volume of applications. What happens in California if California is next? California has about 5 to 6 times as many people, 5 to 6 times as many applications as Washington State. And they're an even larger employer to individuals outside than any other state generally. There is a large opportunity ahead of us, and it all starts with educating our clients on long-term care and putting together an adequate plan centered around real funding that is sustainable and something that they'll keep, not just a tax avoidance. So that wraps up the content that I had here today. We'll open it up for any sort of questions that may have come. Trisha, did you have any questions pop up in the chat box?
Yes, we've had several, and can I just say, wow, I mean, I personally have seen this presentation a few times. I've read through it several times, and I still have another page of notes on just different things that as I keep absorbing it, this comes up and that comes up. So please keep typing your questions into the question box, and we're going to answer them. One that came up: what about a Washington State resident that is a W-2 employee of a company based in another state? Are they still subject to the W-2 wage tax?
So generally the answer is yes. Typically because they have that Washington residence, they're paying into that PFML, that paid family medical leave tax that or program that I alluded to earlier. The easiest way to find out if your individual client is paying into that, if they're a Washington resident working elsewhere, is to just have them check their pay stub and check for the PFML if they're paying into that.
Okay. Yeah, thank you for that. Interestingly, just another comment, many clients don't even realize where their employer is based out of until something like this comes up. So, for any large corporations that are headquartered in Washington State, they might have branches and employees throughout the country. What are the 1080Ls for the Washington CARES Act? You referenced that it's 1080Ls. What do you know what the 10 are?
So I don't know them offhand. It's the same 6 that we have for traditional long-term care. cognitive impairment, and then there's three others that I don't quite recall, but that's something I can get together and send over to you, Tricia.
Okay, great. Yeah, and then I'll send it out to everyone on here because that
Yep,
one actually came up a couple of times.
yep.
And what counts as an opt-out policy? What qualifies as an opt-out policy?
So that's a great question. That's something I meant to touch on. So it's actually a qualified LTC plan, which means that it's 7702B qualified. So essentially any traditional long-term care, any of the hybrid products such as Nationwide's Care Matters, and then any life with a 7702B long-term care rider. Those are the types of policies that qualified for the exemption. Things such as chronic or critical illness riders do not, because that is not a true long-term care rider. So only 7702B qualified policies.
Okay, thanks for that. And I actually just jumped on, I know you can't because you're sharing your screen, but I just jumped on the Washington Cares Fund website,
Mhm.
and I will email this link out to everyone, but it's wacaresfund.wa.gov. And the ADLs are medication management, personal hygiene, eating, toileting, cognitive functioning, transfer, body care, bathing, ambulation, dressing. There are no further definitions available for what do they mean by
Mhm.
body care, by what degree or what level they're required, but those are the 10. All
Perfect.
right.
Thanks for that.
Yeah, sure, no problem. Yeah, that is actually the state website, and I will tell you that website updates almost daily.
Mhm.
And so, it's like, but I saw this yesterday, and well, it's not there today. So we
Mhm.
run into a lot of that. One question that's coming up: how close are some of these other states
So
to
California,
going live, so to speak?
absolutely. So the closest is California. California is expecting to have something by 2024. They do have a website um, that is showing what their immediate timelines are, but California is the closest. The one wild card that we have is the federal government because we're not really privy to when they may implement something, which may be sooner than 2 calendar years.
Okay, thank you. Um, just the rest of the questions we've already addressed. Can I get a copy of the slides? Yes, for everyone on here right now, I will send out a copy of the slides along again with that link to the Washington residents. So
Mhm.
just a ton of information. I'm sure as you absorb it and start having clients that either work in Washington state or one of these other states, or you just come across it and kind of go, well, what about different things? Please feel free to reach out to me, reach out to Josh, and we can try to guesstimate what these other states are going to do and plan. But it is something to be aware of because it's on the books. And
Mhm.
those of us on the East Coast, we kind of thought about it and went, oh, it's Washington State. It doesn't really impact us. I know I personally have gotten several phone calls in the beginning to mid-October saying, oh, I just found out my client has a brother, parent, child in Washington State. They want to get coverage. And I would have to say by mid-September, I don't think I had a carrier that was taking business in Washington State, not because they didn't want the business, but they said they're not going to be able to issue a policy by the deadline. So they're just not even going to try because they just couldn't do it. So, that's why reaching out to the clients and just, letting them be aware. And that is part of the theme of this entire month, LTC Awareness Month, is for us to be aware of what is going on and making our clients aware. So, just in closing, I want to mention the next in our educational series. I'm actually going to be doing a webinar next Wednesday, November 10th at, again, 2 o'clock Eastern Time. It's on how to start the long-term care conversation. So if you have not been engaging your clients in long-term care or haven't been doing it recently because the answer was always no, what if I never use it? It's never going to happen to me. I'm going to share some of the tips that I've picked up from agents like yourselves throughout the years on how to approach clients, what has worked. Also, I'm going to be giving a few tips that I've picked up from some underwriters along the way in my years on how to ask medical questions so that we get a few less surprises along the way throughout underwriting. So watch your emails for a link to register for that, and also keep watching your emails. Going to be doing a lot of blogs, a lot of articles and things like this month for LTC awareness. So I want to thank all of you for joining us today. I hope you found it useful and successful. And as you digest it, have additional questions, and give me a call. The office number is 800-524-1774 if you don't have it. And of course, Josh, thank you so much for taking time out of your day and putting all this together. And thank you to Nationwide for really diving into this and putting together such just a factual presentation on this subject.
Absolutely. Thanks so much for having us, as always. It's always a pleasure.
Thank you all very much. Have a great afternoon and a wonderful rest of your week. Bye, everybody.
Take care.